Hi, my name's Jonathan, and for those of you guys who don't know me, I've been trading. Hi, my name's Jonathan, and I want to bring you guys into my trading journey. So I've been trading for about a year or so, and I just started making these videos just to show you guys my process and my the things that I learned, so you guys won't repeat the same mistakes that I did in trading. So let's just get straight to it. So in this first ever trade, so I want to tell you guys something. This trade is the first ever trade that I made on a funded challenge. So yeah, so this will be my first ever funded challenge account, and yeah, I'll just bring you guys into this journey that I'm into, and just to see if I really do get the do really get funded or not. So yeah, um the funded account that I got, it was the $50,000 one, and I bought it from Alpha Capital. It was about 297 US dollars. So yeah, and in the first ever trade I took, it was a loss, and it's not a big loss. It was just $45. Um, and I tried to keep it that way because trying to keep yourself in a smaller position will eventually help you in gaining confidence, especially if you're like new traders and you don't really know what to look for or what to do. So trading a smaller position, and if you made a mistake, and if you uh did wrong analysis, it won't really affect you as much if you did like a big position. So yeah, every time before I trade, I would always look into what's happening around the market. So the first thing that I would look into would be the macroeconomic news, and what are the things that might affect the certain ticker that you'd be trading today. So I'm gonna be trading. So I was trading Nas 100 futures today, and so I was just looking at any news providers that and news articles that might affect the price movement for today. And I found this article that's been saying that hedge funds have been shorting the VIX for about 59,000 contracts for the past 16 weeks. And what this means is that I know that the market volatility index is pretty low, and that might indicate the price to go higher because, VIX usually reflects on the investors' fears. And another article that I was looking at is that investors was still on the positive side of the market, and they just kept on trying to buy the dip. But one thing to keep in note is that there was too many investors that were trying to buy the dips, and any loss of confidence in the group might put the whole market at risk, since they have been buying tech stocks like Nvidia, Apple, and Tesla, and any loss in confidence in that might put a might affect the Nas 100 or the S&P 500 and stuff like that. So let's just go straight to the second thing that I will be looking at during pre-market session, and that will be a technical analysis. So in this technical analysis, I will always look for areas where market always bounce from or reject from. So what I meant by that is this: I was just looking at the supply zone or the demand zone. As you can see here, this was a pretty heavy supply zone, as when price went up here and got rejected, but then went up here again. Although it made a small high here, but it didn't really go long, like it didn't really last long. so it just went down again and went up again and just got rejected again. So I assume that this was a pretty heavy supply zone, and the purpose of drawing these boxes is just to see whether or not when price goes back to that zone, which one will be more active. Either sellers will continue selling in this area, or buyers will step in and like drive the price higher. So yeah, that was just the things that I would look for in the zone. So that's why I marked the zones. And let's just go straight to the market open. And as the market opens, price sold off, went down to the second demand zone that I marked on the charts. And yeah, so on this first ever trade on this funded challenge that I took, it was a pretty big mistake, as I was just trading on a public holiday and I didn't know that. So while I was analyzing the volume of this price movement, I saw like the price was declining, and I assumed that as when the price went higher and the volume was declining, I assumed that there was low market participation. That means there's no interest in the higher levels. So I assumed that the price will go lower. But when I checked at the cumulative volume delta, or the buying and selling pressures, I didn't really, like show any divergence or like difference between the movements. So I took a hit on my stop loss, as that volume decline was just because of a public holiday. All right, moving on to Wednesday. Wednesday was the second day that I took a trade on this funded challenge. And again, in the first trade, I took another loss, but this was just like a small loss. I only risked about $60, but I got stopped out. I think it was about $17. And yeah, let's just go straight to the pre-market analysis. Again, I was looking at the news just to see what's going on in the market, just to keep myself aware of what's been going on. And I was looking at, like Trump, the that imposes like 25% tariffs on like 3 new sectors. Initial jobless claims, just key events for the week that might affect the certain index if you're trading. Like if you're trading Chinese stocks, you might be wanting to look at geopolitics, or like news about China and stuff like that. Or if you're looking at forex, for example, there's more things that you might want to look at if you're trading forex or crypto and stuff like that. But yeah, just try to keep yourself aware of what's going on, and if you don't know, you can ask ChatGPT. So during pre-market, market opens up with a gap up here, and that shows some strong demand in this area. But as price was moving up, it broke through that demand and it retested, got rejected. But then I saw like a pretty heavy supply zone over here, about 22,180 until 22,200 ish, right? And for the demand zone, I saw a pretty strong demand, just about 22,130 ish. So that's for the pre-market session. Let's move on to the market open. For the market open, my initial plan was just to wait for for the open, because I was just looking at this demand and price was pretty supported by the demand. But then I saw a rejection in the first 10 minutes of 9 a.m. So I was like just not sure about what's going to happen. So I was just waiting for it to, show me what's going to happen, like what's going on. And then I took a look after the market opened. I was just waiting and waiting, and then I saw this in my volume indicator. So the purpose of this indicator is just to indicate if market participants are interested in a certain price movement. So in this case, when price moves higher, I saw a decline on the volume. This indicates that there was lower and lower market participants, or lower interest in the higher price level. So you can assume that when price goes higher, there was really no buyers interested in buying the price at that level. And I checked I took a look at my cumulative volume delta indicator. So this tells me that how strong the buying or the selling pressure is. And as you can see here, there was a difference between the price and the delta. So when the price declines and the delta made a higher high, this shows a strong buying pressure, but it was not reflected in the same way as the price would be reflected. So if you have a lot of buyers, but then the price eventually goes down, that means those buyers are not as rewarded or as accepted, or like, how do you say it? Those buyers are not as, how do you say it? As respected. Sorry. So those buyers are not as respected. So that's why when you see like a strong buying pressure on the delta, but then the price closed lower, you can safely assume that there were more sellers, or the buyers are not respected, or there were just some stop losses of buy orders. So yeah. And I took a look at the footprint chart, and what I saw here is just the same thing with what I saw on the volume indicator. And when the price went higher and higher, you can see here the volume was declining and dying um, over time. So at 9:49, you can see here, for example, it was like 1,300 transactions, and the next minute it was only 1,004. The next minute was also 1,004, but in the next minute there was like I think 3 minutes gap. They declined. They went from 1,300 to 900, and then boom, there's only 872. So I can safely assume that there was low market participants, no buyers being respected, and you can safely take a short. But what happened here and why I took a loss is that my stop loss was way too tight. So this was the first lesson that I learned, and I should have learned this from the past year of trading, but I just kept on making the same mistake. So yeah, hopefully you guys learn the same from the mistake that I did. And on the second trade, I basically took the same trading idea as this was just a few minutes gap between the first and the second one. And as you can see here, I placed my stop loss a bit too tight again, and I just got stopped out when the price wicked higher, like jumped higher a bit, and I just got stopped out there, and this kind of caused me some FOMO because I was right in my analysis, but then I took a loss, and it was just like a terrible feeling if that happens. Yeah, because when you're right, but then you're not rewarded, so it's just a terrible feeling to happen to you. But then for the third trade, I took the same idea again as from my first and second trade, and it took me just a couple of minutes just to score profit. It was a quick one, just quick grab and go for like the next 2-3 minutes. I learned from my lesson, kept my stop loss just a bit high enough for the price to actually move around. So yeah, so I was just risking about $68, and I made about $130. You could say it was like about almost twice the amount of the money that I risked. And for the fourth trade, I wasn't supposed to be trading, and I was just trying to make a quick cash. And this is the mistake that I learned from trading, and over time you'll see why it's bad to trying to predict the market movement. And it's because you never know when will be where will be the like the bottom price, or where will be like like all right, moving on to the fourth. Okay, fourth trade. All right, moving on to the fourth trade. So another lesson that I learned from trading in the past year is that a bad it would be a bad habit for us traders if we kept on trying to catch the bottom or the top of market movements, because we will never know when will be the bottom, or when will it be the like the most expensive price, and you know fuck. All right, fourth trade, go. All right, moving on to fourth trade. In the fourth trade, I tried to catch the bottom. So when I saw some demand here, and I was just trying to catch the upward movement before it retraces back to the supply zone and goes down lower. But what I didn't see was that there was some continuation in the demand, and as you can see, when price moved higher and higher, the volume kind of like stayed consistent, and not in those aggressive sellers that were present in the market wasn't really as rewarded anymore, or as respected anymore. And as the price moves lower, the price closes like higher than where most sellers were. So that indicates a signal for a reversal, or like a shift in market sentiment. And from that, sorry, yeah, from that I learned that the market demand has just shifted. So from being stopped out when price moves higher, I got a little bit FOMO, and this fifth trade was just a small mistake that I had, that I took, that I made. Sorry, that was just a small mistake that I made, and I got stopped out because I wasn't really buying in a strong level, or like a strong demand zone. That's why when price showed some demand here, it got quickly wiped out. So moving on to the sixth trade of the day, I think. Yeah, sorry, the sixth trade. Here you go, the sixth trade of the day. Sixth trade of the day. As soon as I got stopped out, I waited for the price to reach the previous demand zone over here. But then I quickly switched sides because I was getting FOMO when I tried to catch the move downward. But what I didn't see was that the demand was getting stronger and stronger. And as you can see at 10:21, there was only about 79 buyers and 53 sellers. It was pretty much most transactions were happening around these levels. But as when price went higher, the suppliers were trying to drop the price lower. And as the next minute, that was like 10:23, I believe, yeah, 10:23 opens, and price tried to retest these levels and see if the demands were still there. And it was there. It was really present. And as you can see here, where there was only about 53 sellers, now there's 90 sellers. Although there was more sellers around these areas, but those demands really supported those prices, and it closes just above this supply zone. So I can safely assume that the market sentiment has just really shifted, and it really signaled a pretty strong reversal for me. So when price moved lower, you can see here, although there were about 800 transactions happening around here and there's only 600, but price closed higher than the previous closing price. That sorry. So when mistake fix 1, 2, 3, go. So when price moved lower here, as you can see, there was only 668 transactions happening. This can signal that this would signal, like, give me the signal that the market participants were not really interested anymore at these price level. So it went higher, and when it closes higher than the previous one, where there was more sellers around here at 1022, that really gave me like, oh, buyers were more active this time, and they really want to drive the price higher. So from that assumption, I took a chance and I went long. And as you can see here, from seeing those volume declining when price went lower, as soon as it goes higher, you can see it slowly increases, right? Although it's like the movement was like, like, not mistake fix 1, 2, 3, go. Alright, as you can see from that analysis, I went long, and I put my stop loss here just in case if my analysis are wrong, because in the market you can never know what will happen, and you could, it's every move that you take, or every choice that you make in like trading, it will just be another probability. So it will never be 100%, because you never know if buyers here will keep on buying the price and driving it higher or not. In some cases it might happen is that when price reaches here, sellers came back in and started driving the price lower. So that's why in trading you should have an edge, and by having an edge means that you know when you're wrong, and when you're wrong, you will try your best to cut your losses, because if you can't accept that you're wrong, those losses can put you in a bigger drawdown. So that's not what you really want in your trading journey, because that can really affect your psychology and your confidence in the next trades. So that's why it is important to keep an eye on your stop loss and your emotions. It's fine to it's totally fine to be wrong in your analysis or your entry, as long as you know when you're wrong, you accept it. And that's the best practice in trading. Alright, as you can see here, I checked at the cumulative volume delta, and just to see whether or not those selling pressures really got absorbed or not. And as you can see here, when price moved lower with the really strong selling pressure, it got rejected and closes just a bit higher than the previous swing low. This gave me the signal that, those sellers wasn't really as rewarded anymore or as respected anymore than the previous minutes. The previous minutes. And yeah, although my execution was pretty good and I was able to adapt to the changing market sentiment, I couldn't really hold my trade and I couldn't really manage my trade. So my initial take profit was here because I was already at a drawdown, you can say. I tried to just, like make some small money, and I expected that the price will get rejected and move over here. So as soon as this candle closes like this with some rejection over here, I got a bit scared, so I closed my position, and as soon as I closed it, the next minute opens, it just flied higher, like to this original take profit. It just flew higher than what I expected it would, like, like mistake. Okay. 1, 2, 3, go. So although my executions was pretty good, my uh, management was pretty bad. As you can see here, I entered here, right? And my original take profit was here. So what happened was, when this candle closes, it showed me like this, big rejection over here, and that really got me scared, and I just closed my position. And as soon as I closed my position, the candle jumped higher to where my original take profit was. And this kind of things will happen, and you can't really control it. So when this happened to me, I got FOMO. Like, obviously I could have made double the amount of money that I was making. So I only made like $61 and I was risking about 56. It was barely a break even of what I was risking. Although although the entry was really good, but when the trading management, like, was bad, it just really would really affect your psychology. And when this happened, this is where you want to stop or size down, because once this happened to you, you will continue to look at false signals like that you create in your own head, and that is just a bad habit, because if you are trading in FOMO, or like in fear of missing out those big gains of big money, that would make you think, this is a pretty good opportunity, and I'll just jump in with a big size and make that money that I was supposed to make, right? And if you expect that, then you will get chopped up by the market movement, because once the second you do that, you will lose your edge, and by losing your edge, you really don't know where you'll be wrong or you'll be right, and that's just a bad practice if you do that in trading. So I completely stopped trading for the day after that FOMO, and I checked the charts in the morning, and it went crazy. So when this happened to you, it will, make you think that, if I would just hold my position for the next minute or so, or if I would just hold my position for the next hour, I could have made so much more. But if you kept on thinking like, like that, it will never bring you, it will only cause you to lose confidence in yourself. And if you lose confidence, you will start to question your edge. Like, oh, should I close now, or should I exit now, or should I kept on keep on holding it? And if you lose that edge, or like, like that confidence in yourself, you will never be able to tell, like, so once so after that happened, after that fear of missing out really took a toll on me, I decided to stop trading for the day, and I checked the charts in the morning, and it really went crazy. So when this happened to you, and this will happen to you, do not think of yourself as a failure, or do not lose confidence in yourself, because you really will never know when the price will stop going higher or will stop going lower. It's like, it's fine if you only make a portion of it, as long as you turned up green. And that's what I learned in the past year of trading, because if you always try to catch the whole movement, you'll only end up catching, like, like, let's say, mistake, 1, 2, 3, go. So after that FOMO took a toll on me, I decided to stop trading for the day and checked the charts in the morning, and price really went crazy. So when I took a look at this chart, I thought to myself, oh, if I could have just held my position for just a few hours, I could make so much more money. Like, I could have made, like, easily $400, $500, or like, 5 times the amount of money that I was making now. And when this happened to you, and when will this happen, and this will happen to you, right? Do not punish yourself, or do not lose confidence in yourself, because once you lost that confidence, you will end up getting chopped up with, like, these wicks, or like, because once you lose your confidence, you lose your edge, and by losing your edge, you will never know when you're wrong or you're right, or when you should close those trades, or keep on holding the trades. So yeah, the key takeaway here is just to, like, try to catch a portion, and just try to end up in profit, in being green. Doesn't matter the amount, doesn't matter the amount of money that you'll be making in the end of the day. What matters is that either you're profit, or you're in loss. So yeah, that was the biggest key takeaway for today's trading day. And for the next day, this will be Thursday. Again, first trade of the day, another loss. This was a pretty big loss. I was initially risking about $40, and I was losing, and I took a loss about $121, so 3 times the amount of money that I was initially planning to lose on that day. Again, every time before a trading session, I always look at the news and trying to keep myself aware. As you can see here, there's a news article saying that, oh, gold reaches all-time high. And the reason why I highlighted this is that every time the stock market, like, so the reason why, sorry, mistake, 1, 2, 3, go. So the reason why I highlighted this is that every time when the stock market is in a has a lot of uncertainties, or like uncertain factors that are really playing around the market or the stock market, like geopolitics, um, uh, high valuations of tech companies and stuff like that. Basically, things or inflation or things that are really uncertain, and that sometimes brings the fear out of big investors. And when those big investors are scared, they tend to run to gold, and that's why I highlighted this, as gold usually becomes the safe haven for investors when a lot of uncertain things are happening in the market, like inflation, geopolitics, and stuff like, and you know similar things. So let's just go straight to the technical analysis, and as you can see here, there was a pretty big supply in this area, pretty strong demand as well. So yeah, I was just waiting when the price moved towards this level or this level. Alright, let's take a look at the small time frame. As you can see, there's another demand here, but there it's not really as respected as this demand, so I might not trade on this zone. Let's just go straight to the technical analysis. As always, I would always wait for the market open, and when it does open, price went crazy, because this would have been a pretty good entry. But yeah, but again, you never know when will be the best entry, where will be the best entry, or like when you try to catch the whole movement, it's just impossible to do that. Yeah. So I was just waiting how price reacts to certain zones, and I was just looking at the volume indicator, and I saw when price moved higher, the volume was declining. You know, same stuff as yesterday or the past 2 days. But what's different this time is that I saw sellers was exhausted. So when you see this, right, in the cumulative volume delta, or the buying or selling pressure indicator, is that when price created a lower low, but then when the delta created a higher low. What that tells me is that the sellers were exhausted. So what I mean by that is that when you have a lot of sellers selling, when you have a smaller amount of sellers starting to sell at a certain price level, like these ones, that means they are not as interested anymore, because they might be in a demand zone, like a strong demand zone, and those buyers will starting to pop in and try to reverse the price higher. And that was my assumption. So from that, I just took a trade, didn't really pay much attention, but I got stopped out. So this is what I've been saying in trading, right? There's no really 100% strategy, right? And everything or every choices that you make will only end up in a probability. There will always be a small chance that you'll make a mistake. It's up to you whether or not you want to take the bigger chance of failure or the smaller chance of failure. That's why back testing plays a key role in this trading journey, right? So if you don't backtest your strategies, you never really know when will be um, when, like, let's say when price moves like in a certain way. Mistake. 1, 2, 3, go. So from that analysis, I just took a trade and I took a hit on my stop loss. This is what I've been telling you about trading, right? And there's no 100% strategies that exist in trading. Every choices that you make will only end up in probability, and it's only up to you whether or not you want to take a bigger probability of winning or a bigger probability of losing, right? And the only way to know that is to backtest. And what I mean is that when you have a certain strategy, you will have to test that strategy and see whether or not how often will you win with that strategy. And from that result or that data, you know that once, let's say, the price moves accordingly to your strategy, but then when you have the data, sorry, mistake, 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 1, 2, 3. So from that analysis, I took a trade and I got hit with my stop loss. It was a pretty big hit. It was about $120 in loss, and this is why you will never know what will happen in the market. Although you have a pretty good strategy and you have a pretty good analysis in what's happening in the market, you will never know what really happened, right? Because when you see a demand here, you never know whether or not the demands will continue to drive the price higher, or those sellers will pop back in and started to, drop the price lower. So this is why back testing plays a key role in a trading journey. Is that when you back test your strategy, you know you will get the data or like the statistics, how many percent of, like, how many times will you be right when you're using that strategy, right? So mistake, again, mistake, fucking English sucks, bro. What the fuck? Right, 1, 2, 3, go. So from that analysis, I took a trade and I took a hit. It was a pretty big hit. It's about $120 in loss. And this is what I've been saying in trading: you never know what will happen, right? So in one time you might get it right, and one time you might get it wrong. It all depends on how big of the chances are will you get it right or will you get it wrong. You'll never know when those buyers will keep on defending these prices, or when will the sellers pop back in and start dropping the prices lower, right? So it's really important to have an edge in trading. So once you have this loss, like pretty big loss, because although your analysis was correct and everything checks out to your strategy, there will always be a small chance or pretty big chance that it will not go in your way or what you expect it to do. So yeah, that's the importance of having an edge in trading. So when you took a loss, you accept that you were wrong at that point, because what I learned in trading in the past year is that the market will always be right, and you will have to adjust to the changing market sentiment over time. So you have to adapt to those changes, and if you can't adapt to those changes, you'll only get chopped up, or get in a big drawdown. Because if you can't accept that you're wrong, then expect that you will be losing a lot of money. So yeah, after that mistake, I had a bit of a FOMO, because if only I shorted instead of went going long, I could have I would have made a lot of money. Like, this was a pretty nice flush, like a nice movement to the downside. As you can see, it was about 200 pips. It's almost a percentage. And that movement got me into like this FOMO. And when price showed me like a setup that I always trade, like a strategy that I always trade with. As you can see, I always trade when I see some buyers getting rejected, sellers starting popping back in, and this was a pretty good entry, to be honest. And what happened here was that I scaled in. So from losing that $120, I wanted to make more money, right? I wanted to end the day with profit. By having that kind of mindset, it kind of like gave me the urge to um, take a bigger risk to make bigger profits. So I this was the first trade was a pretty good entry. I was making about $200, I think, or maybe 150, 200, 150 to $200, right? And when price kind of like find a demand in this area, I took another trade. So I kind of like scaled in, and I was just hoping that sellers will continue selling when prices went up here, right? But what I didn't see was that I was too blinded with just trying to make huge profits, and I didn't see that these sellers were not as respected anymore as what I used to do, right? As you can see here, there was only 35 buyers here at this, only like there was about 104 sellers, but price closes just above here. But when it goes lower, right, those buyers that were in these levels, they increased, like they popped back in and kept on supporting the prices, right? As you can see here, there was like 136, 130, and 109 buyers, right? And when price went lower again to retest these buyers again, more buyers started to come back in at a lower price, and that fueled those price movement to go higher. And when it retested again, the same demand zone, sellers came back in. And when sellers came back in, it failed to get respected. It failed to be, it was not respected, right? And how do I know that? Is that when, so the purpose of having this blue box is to identify where most transactions happen. So when these sellers fail to, so let's say when you have this blue box, that means um, this area is where most volumes were located, right? These area. And when you have a lot of sellers trying to drop the price lower than the previous area where most transactions happen, right? So why do I highlight this area? Is that when most transactions happen, is that uh, you can say that that area is like kind of like the fair value, or like, you know, where price is most valuable to buyers and sellers, right? And when you have a lot of sellers popping back in trying to close below that specific value area, and they failed, which they obviously did here, and they have a higher fair value area where most transactions happen, that gave me a signal that, oh, the sentiment has just changed. That means more buyers are starting to pop back in and demand the price to go higher, or the sellers were exhausted in just selling and like getting absorbed, getting unrewarded, getting disrespected. Basically, the price wants to go higher, and because I was blinded to make a bigger profit, or like trying to make it big on that day, I ignored those signals, and from making about $400 in total, because I was making 200 on one trade, and I was making about one like $50 or like $70, about $300 to $400, sorry, right? And once the price started to go against me, I kind of like you know couldn't accept the fact that it happened, right? I couldn't accept the fact that the market sentiment has just changed. So when that happened to me, I was in the drawdown of like 190, about $200, right? And I decided to cut the losses, because if I did not cut my losses, I would have lost so much more, right? I cut my loss about like 150 ish. So that was a pretty um, painful lesson for me to learn, is to accept the fact that I was wrong and try my best to adapt to the changing situations. That will be our hardest job as a trader. So from that mistake, I kind of like went into a FOMO. So I switched sides. This was kind of a lucky trade, to be honest, because price moved quite fast, and yeah. So what I learned from my previous mistake is that I wasn't trailing my stop loss, because I was kind of like too happy to a bit too greedy. I got a bit too greedy of making like $200 and $300 at a trade, and I was like a bit happy that I would make my money back that I lost in the first trade that day, and I wasn't trailing my stop loss. So when price so the purpose of trailing your stop loss is that, just in case if price goes against you in a certain level, you when you get stopped out, at least you make some profit. You know what I mean? And that's what I learned from the previous trade, right? So I trailed my stop loss, and how do you trail the stop loss? If you were to ask me how to do that, is that when price so usually if when price moves, um they tend to fluctuate, right? And when they fluctuate, they usually have some supplies over here, and then when they do have some supplies, it kind of like retested the previous demand, and see whether or not those buyers are still interested in these levels, right? And if they're not, it will go lower, and if they are still interested, it will definitely go higher, right? That's just basic supply and demand. So when price retested this demand, it kind of like it showed me like small um, support of demand, and what this candle at 1019 showed me is that these sellers were way more aggressive than the 1018 sellers at these levels, right? And when the price closes with this candle, if you can see here, there's another high value, like fair value area where I highlighted it blue, right? So what really happened here is that when price were more aggressive and on the 1019 candle, they are disrespected. And why, you may ask, is that when price closes, it closes just above the previous high fair value area, right? So what that means is that those aggressive sellers, they are not getting, like, I don't know, respected. Sorry, mistake. One, two, three, go. So the mis- so what I learned from my previous trade is that I wasn't trailing my stop loss, right? The purpose of trailing your stop loss is when price moves and when it fluctuates, and when it does fluctuates, it it will obviously go against you, right? And you will never know whether or not the support or the demand or the supplies were going to be active in that specific time, or are they going to continue supporting the price or not. You will never know that, right? So the purpose of trailing your stop loss is that when price do go against you, you'll get stopped out, but you'll walk away with a profit at least. So because, well, I was trading in the previous trade, like on the second trade of that day, I was a bit too happy and I got too greedy and I just wanted to make the whole take profit basically. And I didn't trail my stop loss because I don't want to make a portion of what I was making at that time. But what I didn't expect was price will always go against me when it fluctuates, right? And it will be harder if it when you were like making like 250 $500, and when price goes against you, it'll be harder for you to accept that you're wrong and hit your stop loss and ended up losing about like what you're initially losing, than just making a portion of what your P&L was, making you. You know what I mean? Because if you do trail your stop loss, at least you're making a portion of what you're supposed to make, and that will eventually boost your confidence over time and help you in trading, better conditions and better psychology. And if you don't have that, you'll eventually lose your edge, and by losing your edge means you're losing money basically, right? And what happened here is that I saw price fluctuates because there was more suppliers coming in at 1018, and normal supply and demand, when there was more supplies than demand, price goes down, right? And what happened here is that at 1019, sellers were way more aggressive than 1018s, right? And what exactly happened here is, as you can see here, there's this fair value area where I highlighted it blue, where most transactions happened, where this was basically what happened just now, like, right, where sellers got more aggressive here, but those sellers failed to close the price lower than these levels where most transactions happened. Means that there were more buyers starting to pop back in that absorbed those sellers' effort to drop the price lower, right? So when that does happen, it means there is a bigger bigger chance of price going higher. But there's a small chance that price might go lower, and you'll never know, right? So that's the purpose of trailing a stop loss. If you have a stop loss here and price goes lower here, or like closes lower, you know that you are wrong and sellers came in to drop the price lower. So that's the purpose of trading a stop loss. And yeah, so I exited my trade here just because I saw a pretty strong sellers here, and they this time they got rewarded, and the buyers wasn't really as respected anymore because they closed just below this area where most transactions happen, and more sellers starting to pop in, and they got more and more aggressive. And as you can see here on the next minute, they're about 185 and 117, 127. So basically the market sentiment has just changed again. This is what you want to look for in trading, and you should always expect that these things will happen, and you should adapt to them, right? And yeah, so I took another trade after waiting a few minutes, like 1, 2, 3, about 10 minutes. I think I was just waiting, and I saw an opportunity here, but what happened was I got stopped out. This time I know I was wrong because um I saw some buyers getting disrespected here, but I thought the price would go higher and higher, but these sellers was like getting stronger and stronger at the lower levels, and when sellers were getting stronger at the lower price levels, that means you want to expect that price will go lower and lower. It also means that there's more supplies and demands than demands. So as you can see at 10:33, this is the confirmation that I should exit my trade and accept that I was wrong and cut my losses, and end of story. So yeah, oh, I also forgot. So when you already make like a big amount of money, or when you already lost either you make or lost quite of big money, you should size down. I mean, I don't know. That's what I learned in the past year of trading. So when let's say I make a pretty big profit. Let's say I make $1,000 in profit, right, in one trade. I would always get pretty greedy or too confident. So if I trade after making that $1,000, I would sometimes ignore the small signals, or the signals that I should be wrong, or the signals that the trade might go against me, and that usually caught me up in a bigger drawdown and would wipe out my $1,000 profit, right? So that's why every time, and when I lose, like let's say lose $1,000, right? It's big money, and when I lose $1,000, I would always want to make that back at least, right? I don't want to lose $1,000 for a day, in one day, right? And when you do that, you kind of like get impatient, and you try to risk more in trying to make that $1,000 faster, right? And so when you make or lose like a big amount of money, you should always size down. And by sizing down means you cut down your risk, and by cutting down your risk, it will help you think clearer, and by thinking clearer, you'll make less mistakes. So that's what I learned in the past year of trading. So that's what I did here after I make kind of like not that big, it was like 200, but it's pretty big at that time. So I kind of like cut my position size in half. So basically, in simpler terms, I cut my risk in half. So if I would be trading at a 5 lot size, I would lose about 44, and this time I only lose. Sorry, this time I only lost about $22. So yeah. So this time, this was the final trade of the day, and this was a pretty good trade, to be honest. After that small loss, it helped me think clearly and see where the price, and kind of like read the price action, and where does it want to go, like where does it really want to go. So as you can see here, suppliers, like, they are pretty consistent in these areas, and when price moves higher from 1037 to 1039, these volumes were slowly decreasing, right? As you can see there, at 1037 we had about 1200 transactions happening, right? And the next minute it was only 1000, and the next minute is only like 1008, right? So it's like kind of like getting smaller and smaller in market participants, right? And when that does happen, you can safely assume that those market participants are not interested in transacting at a higher price level. So if you do see that happen, you can enter a trade here and put your stop loss just above here, just in case there were strong demands here. But I want to play it safe because I see pretty strong demand over here, so I just want to like see these demands get invalidated, basically. Like, like basically I want to be 100% sure that, oh, these demands are not valid anymore, or like sellers have gone lower to sell at a lower price, right? So I just waited till 10:43, and at 10:43 you can see here there was about 68 buyers, and at these levels there's only about, like, 38. But then if you see the sellers, if you take a look at the sellers, it was about 21, and about 45 and 61, and the amount of sellers are increasing over time, and the price kept on closing below where most transactions happen in the previous minutes, right? And this is what you want to see if you want to go short. So I took a short here, put my stop loss just above here, where these buyers got rejected or disrespected, right? And as you can see here, I trailed my stop loss again because price will always fluctuate, and when it does fluctuate and when it does go against you, you can at least make a portion of what you're making. And yeah, so I trailed my stop loss here, and you may ask why. It's because when price closes at 10:45, there's pretty strong demand over here, and I don't really want to see price closes just above here. So when I, if let's say price closes above 10:45 candle, that means there's a higher probability that the buyers will are starting to come back into the market, right? So I don't really want to see that. That's why I put my stop loss there. And at 10:47, when price retraced back here, I put my trailing stop loss just here. And yeah, and at 10:48, my third trailing stop loss is just above here when price closes at 10:48. Yeah, and my final trailing stop loss was just here when price closes at 10:49. So yeah, if you do trail your stop loss, at least when price goes against you, you at least make a portion of your P&L, and that really helps your psychology. And yeah, so the reason why I put my take profit just here is because I saw some pretty strong demand zone over here, and I thought price will go higher, and I don't really want to see that. So I just just take profit here just because I want to play it safe. And yeah, it was a pretty nice trade. It was about 8 RR, so I was risking only about $18, and I was making like $150. Now, obviously, if I sized up or like played with a bigger size, I would have make a lot more money with this risk to reward ratio. But I just wanted to keep it safe. And what's more important is that in the end of the day, is that I profited and I made those money back. So yeah, I think that's all for this week's trade recap. And yeah, so I'll go back with the key takeaways for this weekly trade recap. Right, so the first takeaway, always be patient. Whether you're losing or winning, always be patient and stay to your edge. Second takeaway is always put a trading stop loss, right? Because you always want to make a portion of what you're making, right? And the third one, don't size up too fast. Because by sizing up too fast, that means you're exposing yourself to more risk, and by doing that, you can get into a bigger drawdown. Because in the market, there's a lot of uncertain things that are happening, and you don't really want that. Alright, and that's the key takeaway for this weekly trade recap. And I'll see you next week. Thank you.